teach in the last video that we recognize the revenue from the first 60 units, which is the first batch of the original contract, and 10 units of the additional unit. And the total revenue for all of this, considering the credit notes that the company gave to the customer, the total revenue was $6,033. Now, some people might be confused. Why did we use the contract assets account, and what will happen when the company is going to issue the invoices to the customer? Because maybe the company is going to issue the invoices in a different time or at a different time from the time that the company recognizes the revenue. So now let's complicate the case and let's continue and see what if the company is going to issue the invoices, and what will happen if the company is going to deliver the remaining units of the original contracts and for the additional units as well. So let's complete the case to the end and see what will happen to the accounts of the account receivable and for the contract assets, and which accounts will be closed at the end of the day. Let's see. Now, again, remember that the total revenue recognized so far is $6,033, and this is the same balance in the contract assets account. So the contract assets account is the same value, which is $6,033. Now, let's see what will happen if the company is going to issue the invoice. Now, let's come to the time that the company is going to issue the invoices to the customer. The company is issuing the invoices once the company satisfied all of the performance obligations in this part to the customer. So the company is going to issue invoice. And once the company issued the invoice, so the company should recognize account receivable. So the company should debit account receivable. For how much value? The company delivered the first batch, and the first batch was 60 units, and each unit with a selling price $100. So the company is going to recognize account receivable by same value, which is $6,000. Now, when it comes to the credit, once the company recognized debit to account receivables, so far there is two accounts in the balance sheet impacted by this transaction: contract assets and account receivables. Contract assets, because actually we debited before by the same value, which is $6,000, if you remember, which is this one. Okay, so we debited before. Okay, so far we need to reduce the contract assets. So once the company debited the account receivable, it must recognize credit with the same value from the contract assets. Otherwise, it will be a duplication. Why? Because actually the company recognized debit before in the contract assets when the company recognized revenue. So we recognize the same value before in the contract assets. But now we recognize debit in the account receivable. So in order to avoid any duplication in the balance sheet, so we need to recognize credit in the contract assets. So we are going to say debit account receivable and the credit contract assets with the same value. So this is for the first invoice, which is the 60 units. What happened after that? The company delivered 10 units and the company issued credit note to the customer. So we are going to do the same entry with the same value that included in these two transactions. So we have here, as you can see, we have here how many units delivered. Actually, it is 10 units delivered. And how much is the price for these 10 units? Each unit with $80. And at the same time, the company issued credit note to the customers with a value of $15 for each unit of the 60 units delivered before. So the total value here in the AR will be a minus 100. Debit with a minus value exactly like a credit. This is the same value. So instead of saying debit account receivable minus 100, so it is exactly the same value in the credit. So you can say credit account receivable 100. Same value will be in the contract assets. So this is the same value in the contract assets. Now let's do a T account for the contract assets. In the contract assets, we recognize before revenue 6,000. And we recognize before revenue for the 10 units, which is 933. If you do remember here, this is the 933 contract assets. Okay. And we recognized also that we have, and we recognized also that we have credit notes to the customer, which is 900. This is in the credit. Also, we recognize it from these two entries here. You will find credit in the current assets with $6,000. And also we recognized credit with a minus value, which is $100. So if you make a total and the summation for the debit side and the credit sides, you will find that you will find that the total net balance of the contract assets at the end of the day will be 133. Let's do the same for the AR T account. So this is the total value of the debit in the first transaction. You will find it here, debit 6,000, and then you will find also in the debit with 100. So the total net balance in the AR will be 5,900. Now let's understand. You recognized before revenue how much? $6,033. And the total balances of the balance sheet here, which is AR and the contract assets, is what? Let's sum here. 133 plus 5,900. So the total will be what? $6,033. This is the total impact in the balance sheet after all of these transactions. And how much revenue is the same value, $6,033. So the entry after all of this is what? Yani the summation of all of this entry is what? Exactly like what you are saying, debit AR, let's say here, this is the debit and this is here the credit. Debit AR, sorry, with how much value? This is the value of the AR. And debit contract assets, how much value? This is the value of the contract assets. And at the same time you did recognizing for revenue with how much value? With the same value here, which is 6,033. So this is the entry that conclude all of the above entries and transactions. So this is a summary of everything. Okay, now let's continue the example and let's say we need to deliver the remaining units. How many remaining units? From the original contract we have 60 units. This is the second batch. And from the additional units we have 20 units. So the total so far will be 80. Now we need to recognize revenue. Revenue will be based on the average price that we calculated before. Do you remember the $93? This is the average price that we calculated before. And this will be the base that you are going to use to recognize your revenue. So you are going to say that how many units? $80 times the $93 equal 7,467. So this will be the value of the revenue that you are going to recognize. Again, you are going to use the contract assets with the same value and the credit revenue. Why you are going to use the contract asset? Because I didn't issue the invoice. So as long as you didn't issue the invoice, you need to recognize or you use contract assets account. And assume that you are going to issue the invoice. Always issuing the invoice, you have to use account receivables account. So you are going to say debit account receivables account. With how much value? Let's calculate. How much remaining from the original contract? 60 units. How much is their price? 100. And how much is the remaining from the additional units? 20. How much is their price? 80. So this is the agreement with the customers. So you need to understand that your agreement with the customers is reflected in the entries related to the issuance of the invoices, and your accounting and recognizing for the revenue should go as per the IFRS 15. At the end of the day, after completing all of these transactions, everything will be closed, as you are going to see. So this will be the value that you are going to show to your customers in the invoice. So this will be 7,600. So this will be the value in the AR. And the same value will be credited to the contract assets. Now everything closed. You recognize the revenue completely and you issue the invoices completely. Now we need to make sure that balances in the balance sheet are correct. Let's go. If we would like to make a T account for the revenue, so we are going to recognize and record all of the transactions. This is the old balance from the first revenue recognition, 6,033, which is this one exactly. Okay. In addition to that, we recognize revenue in this entry. So this will be the total balance of the revenue in the income statement, 13,500. Now, how about the other entries, other accounts? AR, from the other transaction or previous transactions, we have 5,900. This is the same account here, 5,900. This one. So this is the beginning balance. Let's say this is the beginning balance. In addition to that, you recognized issue of the invoices 7,600. So the remaining accounts, also closing balance of the AR account will be 13,500. So this will be the closing balance. Let's go for the contract assets. Contract asset, this is the opening balance from all of the previous transactions, 133. So you can say here 133, you can see it here, 133 from the previous transactions. In addition to that, you recognized revenue, which is 7,467, so the same value of the revenue. And in addition to that, you issued invoices as a credit, so you have here a recording in the credit, 7,600. Now let's do summation. Let's do a summation. You will find the total debit side 7,600 and the total credit side 7,600, which means that the closing balance of the contract asset is what? Is zero. This means that contract assets, after all of the deliveries, after revenue recognitions, after issuing the invoices, will be settled to zero. Now you don't have any balance for contract assets in your balance sheet. And you only have balance in the balance sheet related to account receivable, which is 13,500. And your revenue is the same value. So again, what will be the impact now in the financial statements? You have receivables 13,500 in the balance sheet, and at the same time you have revenue 13,500 in the income statement impacted in the return earning, I mean. So this is the conclusion of all of the transactions that we have in this complex case, and the reflections of all of the accounts related to contract assets, account receivables, and revenue as well. Contract modifications is really complex, and you need to understand the case at your hand. The business transactions is very complex as well in reality, and you need to analyze it in order to understand which type of contract modifications you have in this business case. The only thing that might confuse accounting teams and the professionals is accounting for IFRS for the contract modifications will go in one direction, and the issuance of the invoices will go in other directions. Issuance of the invoices will go as per the agreement to the customers, but accounting will go as per the IFRS 15. But at the end of the day, after finishing the complete transactions with the customers, and after closing the contract, and after delivery of all of the units to the customers, you will find that at the end of the day, no balance for contract assets, and you have a balance in the AR equal exactly to the balance in the revenue account. I hope the explanation for these complex topics in IFRS 15, which is related to the contract modifications, is helpful for you. My advice, again and again, understand the business case carefully to help you analyze to determine how you are going to do the accounting as per IFRS 15. Thank you. Assalamu alaikum.